Well, I'm delighted this morning to welcome Harry Cordaiy and Gareth Abernethy, who are running the Clime Small Cap Fund. It's a great time to be discussing the small caps because markets have had such a stellar year to date, and yet the small caps haven't quite participated in the party to the same extent. Gareth, we'll start with you. Can you give us the case for investing in small caps right now?
Hi, Paul. Thanks for the question. It's a good one. We think there's a pretty compelling opportunity at present in the small cap equities Australian space. And I think that really stands out when you look at sort of recent performance particularly across the ASX 200 compared to the small ords. So just say to the end of November, looking back 3 years, the small ords accumulation index has returned negative 0.23%. So that's including all dividends. And looking at the ASX 200 over the same time period, that's some 31.47%. So that's obviously a large difference in performance. And we think that sort of obviously presents a bit of an opportunity for a normalization between those two indices. And I think quickly, some of the reasons for that mainly been, we think, large reason for that has been the sort of large dominance of mega funds, ETFs, and passive investment strategies, which have driven flows into those larger, more liquid equities. And additionally, I think looking at small cap sector, we think that really does harbour a number of quite attractive opportunities, like technology, renewable energy, and we think that investors with a longer term investment horizon, with a little bit of more risk appetite, it's a great time to have a look at the space.
Yeah. Well, thanks for that. We'll obviously drill into a lot of those themes that you touched on a bit more deeply. Probably the most dominant effect on markets has been Trump's election and the Republicans winning House of Representatives and the Senate. So it probably means if Trump is to convert his promises on the election into policy, means higher tariffs, lower taxes, more deregulation, more competition with China, and that probably all means deporting illegal migrants. All of that probably means higher inflation, higher rates. How do these themes affect Aussie small caps, or are these just big macro trends and you guys focus on sort of company-specific data?
Yeah, so the macroeconomic policies from the Trump administration, like you just mentioned, Paul, so deregulation, higher interest rates, tariffs, intensified competition with China, we think that is going to create a pretty mixed landscape for small caps. So on one hand, we obviously like to look on a bottom-up perspective when it comes to stocks and to understand drivers and how they have a competitive advantage in their market. But in saying that, you can't dismiss the effect of this administration change. So that'll obviously put some upward pressure on funding costs globally, which typically is a large source of funding for small caps. However, on the flip side, this more deregulated environment should actually support global growth, should stimulate demand and sort of benefit exporters globally. On the other hand, though, so tariffs and reshuffling of global trade relationships, we think that sort of presents a bit more of a nuanced challenge. So Australian companies that supply or compete into markets that have exposure to the US could see some demand dynamic shifts. Obviously might have to shift production or sort of find solutions to those increased tariffs. However, there are a number of Australian companies that currently have exposure inside the US. So any companies that have production or sales inside the US could actually see a large benefit from these changes. And we've already seen two of those names on the ASX, mainly Lisdorp and Reece, have rallied, sort of as these policies have become more talked about the market and people have sort of tried to see the flow-through effects of those. And I think the other benefit for Australia as well is that China, who obviously are a target of these tariffs, they look to have more politically stable trading partners, and Australia could be a beneficiary of that in terms of agriculture and mining, and there's also industrial. So there's while there's also some risks from these changes, we also think there's opportunities, and so we'll be keeping an eye, as Trump comes in January and starts to enact some of these changes.
Yeah. Well, it's a good segue to Harry because obviously commodities are a huge part of our index, and they're a big component of small caps as well. Now, Harry, at the moment, commodities seem to be taking a bit of a breather. We've seen the iron ore price fall from the beginning of the year. There are obviously a myriad effects of the greening of the economy. We still seem to like copper and gold. How's the small cap team playing the commodity theme, and where are the opportunities there?
Thanks, Paul. Look, it's a great question, and it's something that the team definitely does focus on. Is understanding the drivers of the commodity prices, and where we can find opportunities in the small caps. So for us, we've seen a bit of a pullback in slower growth on a global scale, and also specifically in China. We've seen some weak data points from China continuing, and that people have at different points in time hyped a stimulus story, which has kind of waned into a kind of more modest level of stimulus thus far. And that's really allowed the base metals to drift lower. And you're right, iron ore has been also drifting lower, and really within the composition of the small cap space, there's less iron ore opportunities, and that's not really where we're focusing. It's definitely on the copper and the gold, like you said. We think that the copper story is great. We like the electrification. I think over the medium to long term, copper's got a very strong position as a thematic for investment. In terms of finding quality copper miners in the small cap space, that is difficult. We do hold one small cap producing Queensland-based copper name called AIC Mines. Its ticker is A1M. So they've got an operating Eloise mine, and they're in the process of developing the larger Jericho deposit. But really where the team's been focusing more recently has been in the gold space. One name that we've got in the portfolio that stands out to us has been Genesis Minerals. So they're run by a high-quality management team that previously ran Saracen. If anyone might remember that name, they got bought up by Northern Star and used to own half of the Super Pit. So in the last 2 years, Genesis has taken themselves from being an explorer all the way over to having ambitions to be 350,000 ounce producer. They've consolidated operations in the Leonora region, and they're developing quite a substantial Tower Hill asset, which is one of their key kind of growth and catalysts that we're looking at quite closely. So for us, we think that the gold thematic is quite a strong one, and we think it's a kind of defensive place in the mining sector to hold equities.
This is a sort of a question without notice, but what proportion of the small cap fund would be made up of kind of commodity related investments?
Within the small cap fund, we're holding probably close to 8% commodities. And I would say that leaves us as underweight relative to the index. And for us, and that's really it's representative of us just being cautious on the way the commodities have been drifting. And that's actually played in our advantage from a sector allocation perspective in the recent months.
Okay. Another big development in the domestic scene has been the ACCC investigation of Coles and Woolies and their pricing policies. Does something like that create opportunity for the smaller retailers who might be in the same space, or perhaps just consumer stocks generally?
Yes, Paul, that's been a particularly interesting development. I think that, the ACCC investigation and other impacts such as deflationary of food deflation has been making Woolies and Coles a bit less attractive investments. In terms of consumer staples, there's probably less to choose from in the small cap space. However, I think that investment managers and investors in general are looking at consumer staples and saying, hey, maybe we should be reallocating capital away from Blees and Coles towards those high quality consumer discretionary names. And even just over the last couple of days, if anyone's been into Woolworths, they've had some quite big stock issues.
Yeah.
It'll be interesting to see how long it takes until they come back to having full stocks on the shelf. In the way that we would allocate capital within the small cap fund, we like names such as Nick Scali that we've held for a very long time. It's had some recent weakness with a freight issue. And that also creates an opportunity to review the position and maybe top up on weakness.
Both of you, Harry and Gareth, have made numerous company visits and attended small cap conferences and so on. Just to finish off, perhaps you can each talk about an interesting company, either that we're investing in already, or have invested in already, or that you've got your eye on. Anything that stands out? I know our audience always likes to hear about new stock stories. So perhaps you can each give us a stock that you really want to highlight for its opportunities.
Sure. So, Paul, one that we recently saw talk at the UBS conference was Hansen Technologies. So Hansen Technologies, it's a global provider of software solutions, mainly in energy, utilities, and telecommunications. It does sort of billing, identification software, analytics. So you think it's a real business-to-business bit of software. I guess a few things that we found quite interesting from the presentation. So one of its recent acquisitions was a company called PowerCloud, which was out of Germany, which was quite an interesting company. Previously, during COVID, it would be valued up to 220 million euros. However, Hansen acquired it a year and a bit ago for about 18 million pounds. So it was a real fallen angel, one of these things that got a real big valuation during COVID. And there was some concerns around that acquisition, even though it was quite cheap. It was a bit of a more early stage acquisition for Hansen. But I think what they revealed at that talk was that they'd pulled out a lot of costs, really got that strategic direction in the business. And they've already pointing towards sort of free cash flow positiveness to that business in the next half. And that's a great company for them to get right, because that plays right into that sort of green thematic in Germany. So that's smart meter billing. So if you're thinking of the grid changes that are going to happen from the green transition, that's multiple sources of power feeding into the grid at once, and that requires sort of advanced billings from the utility providers, so that they can track these different sources of power and charge the proper amount to the end consumer. And that's where Hansen's solution kind of comes in. Further on the telco side, in the last 12 months, they've finished the world's first fully integrated tech stack for a telco. So if you think of all the different various features of software that a telco would have that run in the background in terms of billing, identification, top-ups, credit card charging, all of these things are fit together by solutions by different companies. So Telefonica, one of the biggest telco in Germany, commissioned a number of software providers, including Hansen, to sort of provide this fully integrated tech stack, which has come off. And yeah, it's been awarded a number of awards in sort of industry presentations, and it's been getting really good sort of positive press. And I think what kind of highlights these two positive trends in the company as well is that new Fernando, who was a long-term operator at the company, who was poached out by REA to sort of run their M&A. So quite a well-known guy in industry, long-term operator at Hansen. He's come back to Hansen again to head their M&A. And seeing that they're a really good track record over the last 10 years, it's great that he's back in. And so, yeah, Hansen was an impressive presentation. We think it's a great way to sort of get a bit of exposure to that.
Just before you leave, Hansen, even though it's a small cap, so this is a company with, I've just looked it up, a market cap of about $1.2 billion. And we've held it for a long time, so we've had a close relationship with Hansen, and we understand it well. So yeah, really interesting company. I think we'll switch to Harry now. Harry, a stock that you'd like to highlight to the audience?
Thanks, Paul. Yeah, I'm going to talk about a new company that it's more kind of more a recent addition to the fund for us. It's called Vicern. Its ticker is VYS, and it's actually operating in a vertically integrated water services business. And they offer end-to-end water management solutions. So that's extraction, pumping, in all that kind of hydro work. And most of its clients are based in the Pilbara. It's interesting. There's a structural shortage of water in the Pilbara, and that's also a bit of an opportunity for them. But firstly, they make quite a lot of recurring revenue from having a lot of the mines in the Pilbara are actually below the water table. So they fill up with water at the bottom, and the further down they drill, the more water they get, and they need to pump it out. So that's a great recurring revenue business for them. And what one kind of new exciting area of the business that we're quite focused on is their asset management division. And that shortage of water in the Pilbara is also an opportunity for them. So they've been partnering with Indigenous groups via 50-50 JV structure they've got access to these aquifers that no one's really tested, and they're quite large. So they're going to work with Indigenous groups to sell the water to the miners in the region. And they're in the position to drill out those aquifers and determine what's the size of the resource and how much they could sell on a regular basis to the mining companies, and solve that water issue for the miners, and also find a way that it works well for the Indigenous communities at the same time. So I think it's quite interesting, proposition, and if they can get it work, that is definitely more of a blue sky area of the business, but it's still something that's quite interesting and is a bit of a value add on top of the recurring revenue that they already have.
So it's quite interesting. That seems a much more kind of higher risk blue sky investment compared to, say, Hansen. I'm just looking, it's got a market cap of 230 million. I'd never heard of the company before. And it seems to be operating in quite a space which is dependent on the goodwill of the local community, as well as on environmental concerns, which in many cases are quite unpredictable or can change. So would you categorize that as a different kind of investment to Hansen?
Absolutely. And that comes down to the way that we run the portfolio. You have to have things at an appropriate risk weight within the portfolio.
Yeah.
But for us, Vicern is a very small weight position in the portfolio relative to a name like Hansen. And at the same time, the valuation of the business does not include that asset management division. It's that's not included or factored into the stock price to a large degree. So for us, when we're doing our valuations, we have to be careful about not factoring things that are non-revenue parts of the business yet.
Look, I think we'll have to wrap it up there, but I found that a very, very interesting discussion, and I think you've given us some real insights into the approach to investing in small caps, and thank you guys very much. And we'll have to have you back in due course, perhaps not wait as long as we did last time, and we can follow up on some of these themes and thoughts. Thank you so much, Harry and Gareth.
Thanks, Paul. Great chat.